This is Charlotte Talks. I'm Tom Bullock in for Mike Collins. It took a long time, but it seems the wreckage of the Great Recession is now finally behind us. But what has emerged might best be called the yes but economy. The unemployment rate is low, yes, but wage growth is moderate at best. The economy is growing, yes, but slowly. Brick and mortar retail jobs are vanishing, yes, but Amazon buys up Whole Foods and all their physical stores. And President Donald Trump has grand plans to boost the economy.
I will be the greatest jobs president that God ever created. I tell you that.
But his proposals on cutting taxes and spending $1 trillion on infrastructure are still in limbo. So halfway through 2017, what is going on in the economy and what does it mean for your own bottom line? Joining me today in studio to make sense of all this is Tim Quinlan, senior economist with Wells Fargo. Good morning.
Good morning.
Dr. Mike Walden joins us on the phone. He's an economist at North Carolina State University. Thanks for joining us today.
Good morning. Thank you.
And finally joining us via Skype is Chris Farrell, senior economic contributor with Marketplace. Hey, Chris.
Hey, thank you for having me.
Thanks for coming. And greetings to everyone. I'm waving at the camera now who are watching us on Facebook Live. What are your views and questions about the economy? Are you working extra jobs just to make ends meet, or do you think things are going strong? As always, we love to hear from you. Send us an email, charlottetalks@wfae.org, or search for Charlotte Talks on Facebook and Twitter. All right, gentlemen, we are just days away from the second quarter coming to an end, the official midway point of the financial year. So what is your headline for the economy at the halfway point? And Tim, since you're in studio, you get to go first.
We're looking at GDP growth on the order of 2.5% or so, which at face value doesn't sound too bad for second quarter growth rate. But the trick there is you've got to keep in mind you've got a bit of a payback from a really weak first quarter. You might recall that the first look at GDP was 0.7. It ended up getting revised a little bit higher to a 1.2% growth rate. But I guess the takeaway here is we're still punching below our fighting weight as an economy. We're talking an average growth rate here on the order of around 2% or so, compared with 3%, which would be roughly the average since the end of the Second World War.
All right, so Chris, Tim just went through with some big numbers there. What do you think behind the numbers, or instead of the numbers, what would you see as your big headline?
The job market. If you think about the economy, and I absolutely agree with Tim and what he said in his outlook, but for most people, the economy is the job market. Mm-hmm. And at 4.3 unemployment rate, that's a good number. Now, the labor force participation rate, number of people in this job market is low, is lower than we'd like it to be. But if you notice, businesses are constantly complaining these days about they can't find the workers they need. And one definition of a good economy is when firms are looking for workers, not workers looking for employers. And so I think the really healthy development in this economy as it continues to grow at this 2% average annual rate is that it's drawing more and more people into the job market. More and more business managements are complaining about their lack of workers, which means they're going to hire and train workers that 2-3 years ago they wouldn't even have looked at.
All right, Mike. What do you think is the headline of the economy so far?
Productivity sluggishness, and that's a technical economic term, but it simply means how output per worker is growing, and we've seen that rate of improvement cut in half in recent years compared to the average since World War II. And it's a fundamental principle. Your economy can't grow faster than the growth in your labor force and the improvement in labor productivity. Labor force growth is slowed because of population dynamics, the aging of the population, the lower birth rate. And productivity growth, again, has not improved, which to many might sound counterintuitive because we've had all this technology breakthrough, improvements in technology.
Sure.
And many people might think that we would see an improvement in productivity, but we can't, and we could maybe talk later about why. But and this has really been going on not just since the economic recovery, not in the last 8 years, but it's been going on for a couple of decades. But I think that's the key, and I think that's going to present a problem for the Trump administration because long run, in order to really generate faster economic growth, and of course in their budget they're projecting, I think, starting in 2020, a 3% rate of growth in GDP, much higher than where we are now as as was stated, they're going to have to improve productivity. Not much you can do about labor force growth unless you open the gates to immigrants and boost the birth rate, which of course is not going to help you until many years down the road.
So it takes a while for that to pay off, for sure.
Yeah.
Well, let's
focus is on improvement in productivity.
So let's take some of these into chunks, because these are all points that are key, obviously, not only to understanding the economy, but for what we need to cover in the show as well. So let's go back to Tim and Chris's point when it comes to jobs. So here are the basic number. Nationally, unemployment rate is 4.3%, 4.5% here in North Carolina. In South Carolina, it's at 4.1%. So this, in the past, has led us to, an interesting term which people may not understand, which is the idea of full employment. What does full employment mean, Chris?
Well, full employment, one definition is full employment is somewhere around a 2 to 4% rate of unemployment is something close to full employment, because you're always going to have some unemployment, right? People are going to leave their jobs. People are going to be laid off. So there's sort of a natural turn to the market. But when people are talking about full employment, it's typically 2 to 4%. These are the numbers that they use. The reason why at 4.3% we really aren't anywhere near full employment is that there are a lot of people on the sidelines of the economy. And the question is, at what point do they become more confident and decide that they're going to enter into the economy? So even though we have a headline number that looks like it's close to full employment, and the Federal Reserve talks about it as being close to full employment, I think on a very practical level, we're pretty far away from that.
Now, Tim, full employment in the past, or being close to full employment, to take Chris's point, has often meant, at least, let's go back a little more than a decade. Early 2000s, the term full employment was being bandied about again. And what we saw was a dramatic increase in wages as businesses were trying to lure the right employee to them. But that's not what we're seeing right now. Wage growth has been, what's the term you would use?
Anemic?
Okay.
Yeah. We're supposed to be excited because average hourly earnings have been grinding higher the last couple of years. We're now roughly 2.5% on a year-over-year basis. If you look at the expansion in the 1990s, the slowest rate of average hourly earnings growth at its low point was 3.5%. So yeah, it's been weak, and I think it ties Chris and Mike's point together because part of the reason that it's been weak is this productivity dynamic. The San Francisco Federal Reserve did a study that basically identified when you have periods of strong productivity growth, we associate that with periods of strong earnings growth. This has, as Mike pointed out earlier, has been a really lousy period for productivity growth. And, here we are with all these measures of, initial jobless claims at their lowest level in 25 years, unemployment rates, well below the 5% where the Fed is usually comfortable raising it. It seems like the economy is at full employment, yet where's the wage inflation?
So, Mike, what do you think is behind this drop in production? And I know that's kind of a nebulous term for people who aren't, well steeped in the world of economy. Production basically is just getting more out of your average worker, correct?
That's right, and several potential factors, and this is really a head scratcher for economists. A lot of work on this. I don't think any firm conclusions, but I think some preliminary ideas. One is the fact that if you look at educational attainment, improvement in educational success or educational credentials, et cetera, it's topped off. We have not seen, we saw big gains in educational attainment in the 50s, 60s, 70s, et cetera, but recent decade that's leveled off, so that might say something about the educational system and the fact that 25% to a third of freshmen who enter college don't finish, so we have some issues there. I recently did a study that I looked at unemployment rates around the counties of North Carolina, found a strong link between counties with higher unemployment rates and counties that have issues with their workforce in terms of overuse of alcohol and overuse of drugs. So I think there's some issues there. I think another issue has to do with the fact that our economy is changing. Many of those people who have dropped out of the labor force, and incidentally, that I think I know my colleagues know this, but the general public might not know that the 4 to 5% unemployment rate does not count people who stop looking for work. When you add those folks back in, it goes much higher. And
I believe that's the U6. Is that right?
Yes.
Explain to us quickly what that is.
U5 and U6. Well, U5, I believe, is adds back in what are called discouraged workers. These are people who could work. they're able-bodied, et cetera, but they've just simply not looked for work in the last month, which is a requirement to be counted as unemployed by the headline rate. And then U6 adds in people who are working part-time, even though they want full-time work. So those numbers are a lot higher, although they have been the commonly quoted unemployment rate, although they have come down. But behind all this is the fact our economy is undergoing a tremendous change. You alluded to some of that in your opening remarks. Technology is entering the workforce at increasing rates, displacing workers. Any job that can be done routinely, like in manufacturing, is being done by technology and machines. So folks like my late father, who worked in the manufacturing all his career, probably couldn't get a job like that now. So we got that dynamic going on also. I estimate there are about 200,000 people, able-bodied people in North Carolina who could work, who just dropped off the radar screen. And it's a challenge. Hopefully businesses will try to get at those folks and pull them back in the labor force and train them. But again, some of them have social issues, non-cognitive issues that really prevent them from being gainfully employed.
So here's the question, gentlemen. I mean, we laid out basically the reason these 2 points are really important is jobs and productivity. That's how you grow the economy. So when you hear a politician say 3% growth or 4% growth, that's how you do it. If we have really great unemployment rate by historical norms and a really, dismal production rate by historical norms, I mean, we're still growing, but not very much. Is this the new normal of the economy, this kind of muddling about where things are fine, but they're not really great?
I think, frankly, it is. And, one way that I try to quantify the new normal rather than just, give my impressions of what it ought to be is to look at the long-run projections from the Federal Reserve. Mm-hmm. So they only began doing this back in 2012, but they said, here's what we think short-term interest rates ought to be in, quote, the longer run. Here's what we think the GDP growth rate in the U.S. ought to be in the longer run. When they started doing that, those GDP growth projections were around 2.5%. Those same estimates from the Fed today are, 1.7, 1.8. It's a realization of the fact that without that productivity dynamic, the potential growth rate has slowed. And, without a significantly faster rate of labor force participation and out a big pickup in productivity, Steve Mnuchin's 3% growth number is, maybe something that could be achieved on a one-off basis in a single quarter, but on a sustained rate, you can't get 3% growth in the U.S. economy without fixing that productivity problem.
And one thing, Chris, I'm sorry, go ahead.
Go ahead. Well, I was just going to say, I think that this is where the surprise may be in our economy, which is we have been going through this period of stagnation with productivity growth. And it's been one of these puzzles because we sort of increased the productivity of entertainment. You go on Facebook, it's easy to keep up with family and friends. You can be watching this show, on Facebook Live. I mean, there's all these things, and with Twitter, but it doesn't seem to be improving the productivity of business. And yet I think there are two things going on right now. We have high productivity in the digital economy. Digital companies have very high productivity. We have lower productivity and stagnant productivity like in manufacturing and other sectors of this economy. And with Amazon taking over Whole Foods, we have a major disruptor coming into a big, important part of our economy, and it's going to drive a lot of investment. With the autonomous driving vehicle, we have a lot of investment that has been unleashed in that sector. So I think there's a real question here whether productivity growth is going to grow because finally we're starting to get the kind of business investment in technology in the sectors where the investment has been weak.
All right, we'll pick up with that here in a moment. This is Charlotte Talks.
Support for Charlotte Talks comes from WFAE members and the New York production of C.S. Lewis on Stage,
awesome
The Most
music.
Reluctant Convert, in Charlotte for 2 performances only, Friday and Saturday, July 14th and 15th at the Night Theater.
Musicians
More at
from around
CSLewisOnStage.com.
That's what that thing was. Wasn't that cool?
Yeah.
And from
Somebody-
Novant Health's
it's
Heart and
one of those things
Vascular
you never
Institute,
know what they're going to
providing
get.
treatment and
And they came up with
solutions to
this,
help
like,
keep
that could
hearts
be really
beating
awesome.
strong.
That could be really
Information at
really
novanthealth.org/heart
good.
health.
One. I'm like, wow,
Later
that's
today, the
great.
Congressional
Yeah.
Budget Office will
There was
release
one
its
where a guy
scorecard on the
sounded
Senate
like he
Republicans'
was
health care proposal.
channeling the lead
Since
singer
that
from
bill
the
was unveiled,
B-52s.
many
That was a
medical
little
groups
weird.
have lined up with Senate
It
Democrats
was still kind of fun, but it was a little odd.
And even some Senate
there was
Republicans
a
and GOP
a
governors are
female
having a
jazz
difficult time
vocalist who
supporting
basically
their
just did
party's
like an
efforts to
acapella
repeal the
version.
Affordable Care
Isn't that
Act.
amazing?
We take a look at the health care proposal
Whoa.
and what impact it could
And
have
it was
on
fun
North
too because
Carolina.
I do the roundup every
Charlotte
Friday, and they
Talks
would bring
tomorrow morning
the
at 9 on
finalists in, the people whose
90.7
themes we were
WFAE.
playing, and so we got to meet them, and it was just like fascinating. There's one guy, hang on. Oh, we got 30 more seconds. Just this guy who's, piano fan, wanted to be a composer but never really took off with it. So I think he was a graphic designer. And just talking to him about it, and he banged it out in like, a couple hours. And it was really good.
Stay tuned for On Point, following Charlotte Talks from 10 till noon. Here on listener-funded 90.7 WFAE, Charlotte's NPR news source.
This is Charlotte Talks on 90.7 WFAE. I'm Tom Bullock in for Mike Collins. And with me today are economist Mike Walden with North Carolina State University, Chris Farrell with Marketplace, and Tim Quinlan with Wells Fargo. And of course, we are talking about the economy, a mid-year check-in on where we stand halfway through the economic year that is 2017. You can always join the conversation. Search for WFAE on Facebook and Twitter. And I want to get back to the point that Chris was just making, really 2 points here that fascinate me. The first is, of course, talking about what has been the big economic news here, at least in the last 10 days, Amazon buying Whole Foods for $13.7 billion, I believe, at a time when retail is really having a tough year. But also this idea of automation and the productivity gap between digital companies versus, say, manufacturing. So I'm curious, and I'll leave this open for who would ever like to answer it. Why is it that we're seeing such high productivity levels in digital companies, but this plateauing off, maybe peak production having been reached in manufacturing?
Well, Mike Walden, I'll take a stab at that. I think it's because that's where a lot of the new technology and improvements are being made. And I think this lends, however, to a point about general productivity and some of the issues we're seeing. Yes, we're seeing a lot of improvements in what you can do with your iPhone, what you can do in social media, et cetera, et cetera. And there is some thought among economists, and I think there's some research just beginning to look at this, that although that may on the surface sound like it's going to help productivity, it may actually cause productivity not to improve as much, may have a negative effect on productivity, because during the work day, almost anyone, anytime, can still look at their iPhone, their smartphone, and get on Facebook and update their social media. I see that all the time, and we're having an issue with that in the classroom. Students don't pay attention because they're all on their devices. I can't collect in my classes where I have 100 students. I can't collect 100 iPhones. I'm not going to do that. So I think there's a downside, especially in the entertainment area, of some of these advances in productivity.
That's interesting. I remember always hearing stories around March of how much productivity is lost from March Madness basketball games. You're basically saying, Mike, that this is now a constant occurrence. This constant distracted working is causing productivity problems.
Yeah, and I think businesses are beginning to look at this. I think we at educational institutions are eventually going to have to look at it. Because the millennial generation, the Z generation, especially the Z generation coming up, I mean, they don't know anything except social media, and they expect to be constantly connected and constantly respond to texts and Instagrams, et cetera, and that distracts them. They have there's been some research that their attention span has been dramatically reduced, and that's not conducive to being a productive worker and being a productive student.
So we've got a lot to cover besides jobs, but I want to end our segment here on jobs with this question. As we were just saying, there are really two main ways to grow an economy. More jobs, higher productivity. We've just dealt with the productivity piece, but I'm curious, when it comes to adding jobs, we're really in the midst of this grand wave of retirements. The baby boomers are now starting to, or have been retiring for some time. And I believe the Pew Research Center estimated a few years ago that it's about 10,000 baby boomers retiring each day, thereabouts. Yep. Is that having a dramatic effect on the economy? Chris?
Well, I think the dramatic effect is actually a surprise. So the labor force participation rate of men from 1996 to 2014 for those 60 and over rose by a third. For women, it rose by about 20 to 25%. What we're seeing is the labor force participation rate of the 55 plus, 60 plus, 65 plus, and 75 plus, it's all going up. Now, there are still a lot of people retiring. People are removing themselves from the job market. So overall, job growth is slow, but there's a fundamental shift with a better educated, healthier population, and also because of really a lack of retirement savings, because we really don't have a very good retirement savings system in this country, that the big surprise is that the century-long trend toward earlier and earlier and earlier retirement bottomed out in the late 1980s, early 1990s, and since then, an older workforce has stayed employed. And so one of the things that as a country we can do if we want to boost economic growth is put in positive incentives for people to stay engaged in the labor market, because all indications are they want to.
So, Tim, I saw you nodding your head in agreement with that.
Yeah, I think there's a lot to be said for many of the points that Chris was making in that. I think one of the interesting backdrops around this discussion around employment is we tend to focus on what was the monthly change in non-farm payrolls, what's the unemployment rate, but there's a slightly less widely followed report called the Job Openings and Labor Turnover Survey. That report revealed in the most recent print that the number of open jobs that we have listed just crossed over 6 million for the first time on record. So we have more listed jobs available today than at any other time. Now, you could take a pessimist's view of that and say, yes, but this is the skills mismatch in finding the right people to fill those jobs. That may well be true, but by any reckoning, more than 6 million listed jobs is a good counter to some of the arguments that there's not enough jobs out there.
So I want to turn to the stock market because earlier this year, the stock market hit 20,000. The Dow Jones Industrial Average hit 20,000. I remember back in 1999, and yes, I am dating myself here, when it hit 10,000, there was basically a ticker tape parade down every street in America. It was a huge moment.
I still have my hat.
This year, it was like, okay, 20,000. And then more or less kind of happy crickets, but still crickets. Why is it that the stock market hitting, a record? I mean, it hasn't necessarily soared since then. It's still 21 and change. But why is it the stock market it seems still to be kind of questioning the fact that it's pushing itself farther and farther and should be, at least on paper, kind of a success story?
Well, I think it's kind of an interesting dynamic in this cycle, the way that financial markets have responded to monetary policy. The Fed, the ECB, the Bank of Japan have all injected a lot of cash.
And the ECB is the European Central Bank.
Thank you.
No worries.
And the intention of that policy is to, stoke inflation and get a sustained rate of 2% inflation. And boy, inflation has been missing in action around the world, particularly here in the United States. And rather than seeing consumer price inflation, what we're seeing is asset price inflation. So home values, stock markets, a lot of these other financial instruments are very, very high and well above their pre-recession peak. And, the markets going on to set new highs is kind of being met with a collective yawn.
So here's the question, too. When it comes to the stock market, I was always told that the markets hate uncertainty, hate it with a passion, and that anytime there's any real uncertainty that you're going to see the stock market dip. Well, right now, just dealing, and to bring this back to President Trump, and I'm doing that out of basically just going along with his campaign, we have promised tax cuts and tax reform that seems at best stalled in Washington. You have questions over 1/6 of the U.S. economy with the health care bill that the U.S. Senate is set to vote on at some point this week, potentially. And yet the stock market does keep going up. Is this old adage, Chris, that the markets hate uncertainty just kind of an old adage, or is it still in play?
Well, I think the thing is, when it doesn't matter what period of history you're in, uncertainty is in the nature of investing. I mean, it's always an uncertain period of time. The source of uncertainty may change. Why people feel uncertain may change. So it's one of those things people pull out of their back pocket to explain something, but it's inherent in investing. But I think what's really going on here is, if you take a step back and just as you're doing, you're not looking at the day-by-day action, but you're sort of kind of looking at the stock market from a broader perspective. And when we look at the stock market, we're talking about the S&P 500 companies, for example. These are basically multinational corporations. Probably the most important factor is that Europe is reviving and Asia continues to grow. And so we're going through a period of time where the global economy is picking up and it's showing up in very strong corporate cash flow. And so in that sense, I don't think it's a huge surprise that the stock market has been relatively strong, because multinational corporations are benefiting, and probably the big, the extra edge to the economy is the pickup in Europe and better cash flow coming out of Europe for our multinational corporations.
But the pickup in Europe goes into, hey, I'm sorry, Mike, I'll be right with you, I promise, but the pickup in Europe comes at a time when they're still trying to deal with Brexit. The potential, with Britain pulling out of the EU and all that uncertainty, and yet the economy there is doing better. Again, is this uncertainty, is that the new norm with the stock market, and they've just kind of, padded it into the market?
Well, I think that I think the uncertainty is always there. I think the corporate cash flow is there right now. If you look at corporate profits, they're really very, very strong. So in that sense, the market's not irrational. But here is the caveat or the twist that I'm watching, and a lot of other people are watching, which is the stock market is strong, as you said. But what the bond market is saying is this economy is going to continue to grow at a relatively slow rate with low inflation. There's just not going to be much of a change. So at some point, the stock market and the bond market have to come in better harmony. And right now, the stock market is more optimistic. Stock investors maybe be by nature more optimistic. And the bond market's a little more, we're not going to be doing much of anything for a period of time.
Mike, go ahead.
You did mention the challenges the Trump administration is facing in their marquee economic plan in terms of taxes, health care, et cetera. But don't overlook the fact that the president's been able to reduce some regulation, change some regulation, which I think the business community likes. They've been controversial changes in the environment and energy, but I think the business community likes. And regulations are very important. There's a study done, published by George Mason University, included a whole host of economists, including a couple at Duke, worked on this. So this was not an off-the-wall type study. It was a very well-done study that estimated that if the collective impact of the regulations, I believe, passed since 1980, not trying to look at their cost benefits, just the collective impact on GDP growth, was to reduce GDP growth annually by 0.8%. That's enormous, 0.8%. So I think that some of the buoyancy in the stock market has been due to the business community collectively liking what they're hearing from the Trump administration, actually what the Trump administration is doing regarding various regulations.
And Mike, when it comes to speaking about the economy, it's probably fair if we think about this really as two economies, because you first have urban areas, cities, and greater suburbs and exurbs that seem to be doing pretty well here. But you get out to rural America, you get out to rural North Carolina, and the economy there is very different.
That's right. I do about 80 to 90 talks a year all around the state, and I'm always very careful when I talk about when I start my talk and say the economy is improving in general, not for everyone in every area. And that's exactly true in North Carolina. It's actually true in most states. If I'm talking to business people in Raleigh, I mean, everyone's smiling. It's a happy place to be if you're in the business community. If I go to Rocky Mount, Laurinburg, Ahoskie, a whole different matter. We do have an urban-rural divide in North Carolina. Most states have. The nature of economic changes over the last couple of decades have definitely helped urban areas. Young people want to be in urban areas. Universities, big research companies are in urban areas. Rural areas, in fact, the state demographer estimates that over the next 3 decades, 1/3 of North Carolina's 100 counties will be populated. Population will actually go down. That's not an issue, again, unique to North Carolina, but it certainly is one that we need to recognize.
And also here in North Carolina, Mike, there's always, this state has a bridesmaids complex when it comes to this. I think it's really, truly fair to say. We often seem to be on the short list of mega sites, some big car manufacturer or an airplane plant that's coming. And it seems like North Carolina, oh, no, we'll go to South Carolina, we'll go to Georgia, we'll go to Tennessee, we'll go somewhere else. And even in the state budget this year, that's waiting for Governor Roy Cooper to either sign or veto, there's this really fascinating clause that Tim Moore kind of walked through in a rather cryptic way. It's basically a reference to what he calls a transformative project. This would come with big tax incentives to lure whatever this unnamed company is here. And here's what he had to say.
So the transformative project has certain criteria. It has to be a project, I believe it's either $4 or $5 billion in capital investment, over 5,000 jobs created. with manufacturing.
And he said this is going to be decided or potentially announced here in days or weeks, and he says that the job count could be as high as 8,600, I believe. Now, it's a
that's when you include downstream jobs, yes. Mm-hmm.
Sure. It's a manufacturing center. That's obviously part of the qualification here.
Right.
Long term, though, for rural counties in North Carolina and America, can they still count on manufacturing to bring the jobs that they need? Or is it basically just a plant that eventually will be automated?
Well, that's an excellent question. I think short term, yes. And I've been in North Carolina State since 1978. I don't know how many big projects I've seen lost, and I've been involved with working with the State Department of Commerce and evaluating incentive packages. And of course, that's very controversial. North Carolina has traditionally been very stingy on those. I think they're loosening them, although they do have clawbacks if companies don't meet what they said they were going to do. But yeah, I think we have a couple, 2-3 mega sites that are already ready to go. I think one is in the Rocky Mountain area, one is south of Greensboro. There may be a third, and these are in more rural areas. So I think short term, yeah, they can bring jobs in. We've seen it happen in other states. It's not for every county. It's not for every rural area. I do think there's a certainly valid point about where manufacturing is going in terms of employment, and I think although we've had a rebound since 2010, the long-term trend is still down with technology and machinery. But people live for the moment. So if we can get 5,000 jobs at a manufacturing plant in a rural area or a near rural area, I think that would be very helpful.
Tim?
I'll take the other side just to make it interesting,
sure.
or at least maybe it's not the other side, because Mike did say in the short term, maybe he would concede in the long term what I'm about to say, which is, first of all, this rural-urban divide is not unique to the United States. London is doing great. The United Kingdom, when you get out to Birmingham, isn't doing so wonderful. Milan is a booming bank center, and most of Italy has an unemployment rate north of 25%. Mm-hmm. Dublin, Ireland, the list goes on. Manufacturing jobs and where they're going. Well, this isn't completely unique either. If you go to Beijing and talk about outsourcing, these Chinese firms would say, "Yeah, tell me about it. All the jobs are going to Laos, Sri Lanka, Cambodia. They're dealing with
it's cyclical. It's happening to them.
Absolutely.
What happened here in the 90s.
And what happens in the next 20 years is those jobs go to robots. Those jobs go to mechanization. I'm not saying there won't be manufacturing jobs, but manufacturing employment in the United States peaked in 1979. Every recession that happens, we lose a bunch of manufacturing jobs, and some of those jobs come back. And, I grew up in a blue-collar town, and I want to root for a manufacturing renaissance. But, history tells me that it's not coming back. And, the manufacturing jobs of the future are going to be higher productivity because of more use of machines and robots. But given the advancements in artificial intelligence and machine learning and mechanization and robotics, manufacturing jobs are going to the robots.
All right, well, we will talk more about our future robot overlords here in a moment after a short break. And also, I want to delve back into Amazon buying Whole Foods and what that says about retail in North Carolina and America and the economy as a whole. You're listening to Charlotte Talks on 90.7 WFAE. Nice choice of music, Chris. That was perfect.
Support for Charlotte Talks comes from WFAE members and Charlotte Douglas International Airport,
like,
reminding travelers to plan ahead when flying this summer.
You watched any of that?
Real-time
I haven't
airport
seen that
parking
yet.
and
I'm dying to see
discounted
it.
travel
It's
tips
really
are
good.
available
Yeah,
at
I did
cltairport.com.
Black Mirror. Just
And
finished
from
that.
Baby
Have you
and
seen that?
Company, a modern
Oh.
birth center.
Do you have
offering
Netflix?
individualized
Yes.
maternity and
Oh,
woman
Tim.
care, classes
So-
and wellness
Black
services
Mirror.
in
Yeah,
a intimate
it's,
setting. More information available at
It's kind of like The Twilight Zone in the fact that every episode is completely different.
Drum up
Oh,
support
I
for their
like
healthcare
that.
bill,
But it has
even within the
a
GOP
common
caucus.
thread, which
And
is
it's
something with
uncertain they'll be able to
technology
pass
is
healthcare
going a
legislation
little crazy.
this week as planned. Business groups have
Some
come
of
out
them
in
are
support of the
brilliant,
Senate bill,
really funny.
but the healthcare
Others are just
industry is
flat out
lining up against
disturbing.
it.
There's a couple
Coming
of
up in
not
20
great
minutes,
ones,
10
but
o'clock on
yeah.
Point with Tom
seasons.
Ashbrook. We'll look at the
I think
winners
it's
and losers of this
fabulous.
latest healthcare proposal.
Yeah, there's
Charlotte
some
Talks continues its
really,
look at the
really
economy
tricky
on
stuff there.
midday
And you never know.
point
They just start
2017 in
cold,
just a
so you
moment.
don't know what the story is going to be.
Yeah.
You just have to kind of catch up as everything happens. It's really cool.
The day moves fast.
just finished
and it can be tough to
a
keep
book,
up
The
with
Second
meetings, with
Machine
friends, with
Age.
the news. Listen
Really
to all
interesting.
things
Two guys from
considered
MIT
for 20
wrote
minutes
it.
to catch up
They
to the
basically
day's
said
biggest stories.
all
The
in
Medicaid cuts
20 seconds.
are even more
Just,
kind of before and after the steam
House
engine.
We
bill.
have been
Like that's
evaluating
when
whether we should
population
put
growth
some
took
type of
off.
travel visa restriction to North Korea. We've not.
Listen to All Things Considered every afternoon.
cool.
I'll have
All
to check
Things
that out.
Considered, weekdays from 4 to 6:30 on 90.7 WFAE, Charlotte's NPR news source.
This is Charlotte Talks on WFAE. I'm Tom Bullock, and we're talking about the economy with Chris Farrell from Marketplace, Tim Quinlan with Wells Fargo, and Mike Walden with North Carolina State University. We'd also love to hear from you today. Give us a note, an email at charlottetalks@wfae.org, or search for Charlotte Talks on Facebook and Twitter. I want to go back to this idea of manufacturing and automation. And Chris, you were the one person we didn't get a chance to hear from before the break, so I'm curious what your thoughts are.
So I think when it comes to manufacturing and automation, both are absolutely right. We're going to have fewer jobs over the long haul. And if you look at, there's a pretty well-known study by Oxford University, and it made this forecast that gathered a lot of attention that over the next 2 decades, 40% of American jobs were vulnerable to automation. And Dean Baker, he's an economist out of Washington, D.C., did a very important calculation. He said, if that is true, we're back to the golden age of productivity growth, back to the conversation that we were having earlier, where you're having productivity growth of around 2.5% to 3%, in which case you're going to create a lot of wealth. And the one thing to never underestimate, we don't know what these jobs are going to be in the future. We don't know what kinds of goods and services people are going to buy. But if you have that kind of strong growth, that strong productivity growth, never underestimate, the ability of the American entrepreneur to figure out a product and service that they're going to want to hire people to work for them and that you and I are going to want to buy. So I really think this automation story fundamentally is an incredibly optimistic story if we get the kind of automation that people are writing about and talking about, but we're not actually seeing on the factory floor.
Like what?
If I can interject, Mike Walden, I agree with that. However, even if we do see a spur in spending as automation creates wealth, the question is what kinds of jobs will be created. They'll probably be different than the ones we have now, which means that those people who are released from their jobs, their current jobs due to automation, will have to be retrained and reskilled. So I think perhaps something we can all agree about is, regardless of what percent of jobs we think is going to be automated or not, is over the next several decades, I think education, particularly at the post-high school level, is going to become even more important than it is today, because we're going to have many adults, people in the 30s and 40s, who have to come back to get reskilled, retrained, because their occupation has been severely downsized by automation. They're going to have to be reskilled, retrained, hopefully, for the new jobs that have been created.
Now, Mike, let me ask this. You're talking about reskilling people mid-career, right? 40s and 50s, they have to learn whatever the new job skills require. This also means, though, they would be entering the workforce, in theory, as an entry-level position. And manufacturing for years and years and years has been the backbone of the American economy for a simple reason. It created a strong middle class. So is what we're describing here kind of, it's great for productivity and for a select few, but it may mean some not great times for the American middle class?
Well, I'm not. It depends on what kind of new jobs are created, and that's, of course, I get asked that all the time. And when I was starting this job 40 years ago, I thought I had all the answers. I think you gain wisdom over time, and that we don't know the answers. Mm-hmm. Economists are not very good at predicting where the new industries and where the new jobs are going to be. So hopefully, many of those new jobs that are created, if they are created, will be middle and higher income jobs. If they're not, then I think what this also says is that we need to think about some new kind of social safety net for those individuals who are in their 40s and 50s and get retrained and maybe have to enter a new occupation where they start at the bottom rung, maybe not making the money that they made in the previous job. We need to look at some expanded form of social safety net. I've actually, I'll give a shameless plug. I have a new book coming out this fall from UNC Press that looks at North Carolina economy in decades ahead and talks about this, of how we're going to have to rethink education, rethink supporting displaced workers, where possibly the new jobs might be what are the regional impacts on North Carolina. So I have some ideas in that new book.
Can you give us a preview?
Well, I think it pretty much goes where we were. I think where we've been. North Carolina is going to become more urbanized. North Carolina is going to have to deal with reskilling, retraining. We're going to have to rethink and probably reformulate higher education. In terms of new jobs, I think they're going to span the gamut from what I call a sort of a Downton Abbey type job expansion, where higher income people are going to farm out a lot of their day-to-day tasks. I think we're seeing that in New York City, for example. That'll create some jobs, all the way to much better paying jobs in the tech sector. I think the premier kind of worker in the future, or new occupation in the future, is going to be logo man or logo woman, people who are skilled in logistics, analyzing big data sets, helping businesses as well as governments know what to do with all this data that we're creating. I tell any family who contacts me and they want to know where Johnny or Sally what they should major in, I say anything in logistics, systems analysis, data analysis, et cetera, because I think we're probably better assured that will happen than pretty much anything else. I think another area that's going to expand is artisanship. I think there's already a rebellion against mass-produced products, and I think there's going to be a expanding niche for people who are making things the old-fashioned way, crafts, and selling those to higher-income people.
All right, well, you did a shameless plug for your book. I'm going to do a shameless transition now based off a key point you just said there, which is data. And I'm still stunned by the idea that the single largest online retailer that I can certainly think of, and I'm sure I may be wrong at this, but when Amazon decides to just buy up an entire grocery store chain at a time when retail jobs are just fallen by the wayside, it seems to me that ability to mine data, to understand consumers, and to try to, literally in this case, soup to nuts, have all their information of everything they want and to have it ready for them at a moment's notice. Is that the only motivating factor that would cause Amazon to plunk down $13.7 billion, Chris?
Well, the other factor is it's going to have a physical presence. Mm-hmm. And one of the things that's going on in our economy with this digital economy is that it's not digital versus brick and mortar. It's how do you merge the two together? And so Amazon realized because it was doing Amazon Foods, and it just really wasn't doing that much, and realized it needed a big physical imprint around the country, which also would give it the data that you're talking about, but then also an outlet. And one of the theories that's out there, and I think it's whether or not this particular acquisition works out for Amazon itself, is that what we're going to see is the revival of the old grocery store, the A&P, sort of the little tiny neighborhood grocery store that's going to offer some good stuff that people are going to walk to, a lot of artisan goods like that Mike was talking about, people are going to walk to or drive their car to, and they'll buy some stuff there, and then link to this vast digital economy of delivery that's going on with Amazon, just like with books. Many people will buy books from Amazon, but at the same time, if they live in an area that has an independent bookstore, they'll also shop at that independent bookstore. So I think it's this physical presence is incredibly important to the Amazon strategy, and so Amazon's going physical. What's then going to happen to Kroger and the other ones who had the physical presence? They're going to have to invest a lot of money in the digital side, which is really hard to do. If you look at Target and Target's troubles that it's been having with its grocery stores, that logistics digital side is very hard to master.
Tim.
Just a couple interesting observations on the Amazon deal. As you said, it was $13.7 billion acquisition, and oftentimes the acquiring company suffers in their stock price the day the acquisition is announced, and the acquired company will go up. Amazon's stock price rocketed up that day. In fact, their overall market cap gain was $14.1 billion. So they essentially bought Whole Foods for free. That's not exactly how it works, but just kind of a remarkable move there. And, to Chris's point about the physical presence, it kind of ties back into what we were talking about earlier, because if you think about the locations of these Whole Foods stores, they're typically nestled into some of the most affluent communities in the heart of the urban center. It's not to say that they don't have a rural presence, but I don't think there are a lot of Whole Foods stores in Rocky Mount.
No. No. So it seems to me to be a great chance with all this data to try to, build profiles, deeper, thicker profiles about the customers. And it also just tells us about how much the economy is changing, where it's not just about the goods that you sell, it's about knowing who you should sell that good to.
And this is a real good example of what economists call disruption in the economic market. I mean, and again, the lack of economists' ability to predict, I don't know, maybe I missed it, but I don't know any economist 30 years ago was predicting this, that the nature of retail would change so dramatically.
I think that's a fair point. All right, gentlemen, I began this hour by asking you for your headline in terms of what you thought of 2017 so far. We've got a few minutes left. I want to make sure we have time to get through this. And Chris, I'd like to start with you. What do you think the headline will be for the next 6 months of this year? Where do you see the economy going?
Well, I think it's going to be more of the same for now. And the headline that I would like to see is every government, every nonprofit organization, every community college, everybody who is involved in the job market with low income, disadvantaged, displaced workers who need training, workers who need reskilling that we were talking about earlier, that there is an enormous opportunity here, and to seize the opportunity. And the more managements complain about they can't find the skilled workers they need, the more resources should be going into getting the displaced, the disadvantaged, the people who are on the sidelines of our economy into the job market. That's the headline I'd like to see.
Mike?
I agree. More of the same. I think the economic numbers, the needle's not going to change much. GDP growth will still come in under 2.5. Job growth, same pace. I believe end of this year, a year from now, there'll be more discussion of the R word, recession. We're now, 8 years? We will be 8 years into this economic recovery, or finished 8 years. That's a long time, one of the longest economic expansions on record. And I think economists will begin to be searching more for problems in various sectors that could lead to a recession. However, I do think, I'll be bold here, the next recession will be a mild recession, garden variety recession, nothing like the Great Recession. Hopefully that's the recession we'll never see in our collective lifetime.
Tim?
So, Mike's right. I think this is the 96th month. Starting next month, we begin the 9th year of this expansion. The longest on record was in the 1990s, went exactly 10 years. Interesting thing, though, in the 90s, the average annual GDP growth rate was 4.3%. Over these last 8 years, average annual growth rate's been 2.2. So, it may well be, Tom, that we are living through the longest uninterrupted expansion in economic history, but, the pace of that expansion ranks at about the slowest in the post-World War II era anyway. So, my sense would be that the next 6 months will be marked by financial market preoccupation with fiscal policy. What is Congress going to do? And, given the fact that we've put healthcare and the Russia investigation at the front of the line in terms of the order that we're doing things, I'm not holding my breath for a big boost to the economy from a sweeping tax cut program or, some really substantive rethink of regulatory environment. So 2.2 seems to be the speed limit for now.
Woo! Let's talk really quickly, too, about those tax cuts, the possible tax cuts. Haven't we seen this played out before? I mean, this is a movie that we'll just take two states that I think probably are at polar opposites of the tax. If you cut it, the economy will grow experiment. You have Kansas, which dramatically cut its taxes, and the economy just did not increase significantly. And then you have North Carolina, well, people could legitimately say this may be the land of the Laffer curve, where the General Assembly keeps cutting taxes and our economy has gotten better. Can we see which story is? Go ahead, Mike.
Yeah, well. First of all, you got to remember that at a state level, 2/3 of the economic activity, except in a couple states, is dictated by what's going on nationally. And if you look at North Carolina, we came out of the recession very slowly. We picked up in the last couple of years. I would not attribute the better growth we had in the last couple of years necessarily to the tax cuts. At the national level, lots of economic studies on how much taxes matter to the economy. I think, and my colleagues can disagree if they want, but I think the consensus seems to be they're not at the top of the list. They can have marginal impact. You always got to remember, if you cut taxes, they're not likely to pay for themselves. That's pretty well accepted, I think, among economists. Politicians of various stripes seem to forget that. So I would not look for, although I'm not against redoing the tax code and making it more pro-growth, as long as we keep a safety net and keep those the functions of the government in mind, I would not look to that tax cuts to be the magic elixir that's going to move us from 2% growth to even 3% growth, let alone 4% growth. I think other fundamental factors are behind, as we already discussed, that slower pace of growth we're experiencing.
Chris, I saw your hand on your head.
And I think one thing that's going to be interesting, and it's off a question that you said earlier, Tom, is how much disappointment is there going to be when the realization truly sinks in, we're not going to get tax reform. We may get tax cuts, but we're not going to get tax reform, major tax reform. And there's a general agreement, particularly on the corporate tax side, that there's a real need for major tax reform. And then the infrastructure spending, a lot of the expectations of higher economic growth were coming from the infrastructure spending, and we're not seeing that kind of plan. So as that disappointment seeps into people's analysis and the outlook of the economy, what kind of impact do we have? And I think what it will be is it raises the prospects of more of the same until we get a surprise on the productivity side.
All right, we'll have to leave it there. Chris Farrell, senior economist with Marketplace, Dr. Mike Walden, economist with North Carolina State University, and Tim Quinlan, senior economist with Wells Fargo. I have to say, gentlemen, this is the first time I've talked with three economists, and the word inflation was barely brought up. Go us. I'm a little surprised by that. Thanks all for the hour here. You've been listening to Charlotte Talks on 90.7 WFAE. I'm Tom Bullock in for Mike Collins.